Hello, all you lovely people out there. How are you all doing? I'm Kate Hill, and I am here as always to give you the best, unbiased and honest commentary about our property markets, along with fantastic hints and tips. Stay tuned for all your latest property news. The Reserve Bank of Australia board has decided to increase its cash rate target by 25 basis points to 0.35% in a bid to control inflation, which, according to the most recent figures from the Australian Bureau of Statistics, is rising at its fastest pace in 21 years. This cash rate target serves as a benchmark for home loan interest rates, and whenever the RBA increases the cash rate, lenders tend to follow suit by increasing variable interest rates. That means that borrowers could soon see their mortgage repayments rise. Buyers looking to enter the property market could see a reduction in their borrowing power as a result of cash rate increases. When banks approve home loan applications, they assess a borrower's ability to repay their home loan at an interest rate several percentage points higher than the actual mortgage rate, known as the assessment rate. With interest rates and mortgage repayments now rising, some potential borrowers might see a reduction in the maximum amount of money that they can otherwise have borrowed, as lenders are looking to ensure that borrowers will be able to continue repaying their home loans, even at higher interest rates. Buyers may experience different levels of reduction to their borrowing power. It really depends on their own circumstances, right? And because of increased levels of household debt, the AMP says that the RBA won't need to raise interest rates to 5 or 6%, as they have done historically, to get inflation back under control. They expect the cash rate to reach 1% by the end of 22, 1.5% by the end of 23. Thereafter, if inflation substantially decreases, then they expect the rates could drop again. The big banks offer mixed forecasts for the peak of the rate tightening cycle. CBA expects the cash rate to peak at 1.25% in early 23. Westpac predicts a peak of 2% in mid-23. ANZ expects the cash rate to reach 2% by the end of 23, and NAB has forecast a peak of 2.25% by the end of 24. They're all roughly the same. The federal budget missed an opportunity to do more to fix the planning system and deliver more new housing, according to the Urban Development Institute of Australia. The UDIA national president says that it focused on helping owner-occupiers, first home buyers and those needing affordable housing, but ignored the rental shortage. There is a real need for more rental accommodation, particularly in the regions where vacancy rates are virtually zero in many, many areas. They say that we partly rely on investors to provide homes for tenants, obviously, but the supply of housing isn't keeping up with the demand at all. Supply side support and reforms are critical. A senior economist at St George Economics says that if unemployment is reduced, then that will likely lead to higher wage growth. They say that this will improve the whole economy, which will have a positive impact for owner-occupiers and investors in the longer term. There is nothing like stating the obvious, is there? The return of investors is unlikely to help ease Australia's rental crisis in the short term. The value of investor lending hit a record high for the first 2 months of 22, according to the Australian Bureau of Statistics. But it likely won't be enough to offset the number of investors who were discouraged from borrowing by the banking regulators, who were put off from purchasing rental properties by the threat of the Labor Party abolishing negative gearing, and those who sold their rental properties during the pandemic. Monthly spending by investors in January was $10.9 billion, which is the highest since April 2015. It dropped slightly in February to $10.75 billion. The investor market has rebounded because borrowing has been made a little bit easier. Some rents are rising slowly and property price growth potential is there. Yields have decreased in the last few months because rent rises have not kept pace with capital growth. They rarely do. Also, many landlords are reluctant to charge market value rent for fear of losing tenants. It's crazy. This makes the purchase by an investor who requires a certain yield much more challenging. A lot of landlords don't realise that. But this should change over the next 12 months as rents continue to rise. Many investors who sold out of the market have sold to owner-occupiers rather than investors. Vacancy rate data from both Domain and SQM Research puts the national vacancy rate at just 1% in March. The ANZ Bank analysis predicts wages growth and build-up of savings during the pandemic will help cushion the impact of future interest rate rises. A senior economist expects wages to continue to accelerate throughout any future interest rate hike cycle. They expect that the unemployment rate will continue to fall, reaching a 5-decade low of 3.3% later this year, they have said. This means that some of the impact of higher interest payments and reduced borrowing capacity will be offset by higher household incomes as our interest rates rise. They say that rate rises don't always result in lower property prices. Why would they? Between 2002 and 2008, when rates were rising, house prices increased by more than 50%. While we don't expect to see such a strong run of house prices through the impending tightening cycle, we do expect the correction in housing prices to be very moderate, especially when compared with the rapid housing price growth over the last 2 years. Foreign buyers are returning to the Australian market with a new NAB survey revealing they now account for 7.9% of demand for new homes. The lift is the third consecutive quarterly increase of foreign buyers and the highest level since the mid-2020s, obviously pandemic. Although still below the peak of demand of nearly 17% at the height of the Sydney housing boom in 2014, and then the increase in Melbourne. The survey shows first home buyers still dominate the new housing market, although their share of total sales fell to a 2.5-year low of 40% in the first quarter of 2022. NAB is predicting a moderate increase in Australian house prices this year, with Sydney and Melbourne recording smaller increases as well. We will keep you posted on all things property from around Australia as our year progresses. Don't forget to subscribe, hit the like button if you are enjoying the free content, and I will see you all again soon. Bye.